Today, we're going to do something a little different. We're going to completely sidestep the hype, the headlines, all the noise, and look at a company through the one document they absolutely cannot spend, their annual report. We are deconstructing the official Form 10K for Bitcoin miner CleanSpark, using their own words to really understand their business, their strategy, and maybe most importantly, the risks they're telling investors to keep an eye on. So let me ask you something. In a world of slick marketing, endless press releases, and just constant market chatter, how do you actually find the real story, the unvarnished truth about a public company? Where do you go to find the story they are legally required to tell you, not just the one they want you to hear? Well, the answer is right here. You go straight to the source. You read its annual report, specifically the Form 10K. This document, this is the bedrock of corporate disclosure. And for us today, it's our complete guide. We're going to walk through it together, section by section, to understand CleanSpark from the inside out, based entirely on what they themselves have reported. So here's our game plan. It's pretty straightforward. We're going to start with the basics, what CleanSpark actually does and where they're trying to go. Then we'll dig into what the company itself sees as its biggest challenges, the key risks. From there, we'll follow the money, decoding their financials. After that, we'll look at how they protect their assets and run the company. And finally, we'll pull it all together to see the big picture. All right, let's dive right in. First things first, what is CleanSpark and what's their grand strategy? At its core, CleanSpark is all about building and operating massive data centers. Their main focus has been mining Bitcoin. But as this report makes crystal clear, that's not the whole story anymore. Okay, before we go any further, we have to define the single most important metric in this entire business, hash rate. The easiest way to think about it is like horsepower for a race car. It is the raw measure of computational power. The more hash rate you have, the more chances you get to mine Bitcoin and earn rewards. And it's measured in something called exahashes per second, EH/s. That's a 1 with 18 zeros after it, a quintillion calculations every single second. It's just a staggering amount of power. And this table really gives you a sense of their incredible scale. As of late 2025, their facilities in Georgia were pulling down about 620 megawatts of power, which translated into over 27 exahashes per second of hash rate. Mississippi added another 63 megawatts to the mix. The big takeaway here is just how concentrated they are in Georgia. That's not an accident, it's a strategic decision, because that state has a favorable environment for miners. But here is where their strategy gets really interesting. The report details a huge pivot that was announced in October 2025. They're expanding into AI data centers. So they're not just a Bitcoin miner anymore. They've gone out and hired an industry vet to lead a whole new division, and they've partnered with a company that specializes in AI data center cooling. This is a massive signal of their ambition to use what they're good at, managing huge amounts of power and infrastructure for the absolutely booming AI sector. All right, so now we shift gears. We've talked about what the company does. Now let's talk about what the company worries about. And, this is probably the most important section in any 10K, because these aren't risks that some analyst on the outside came up with. This is the company's own management, legally required to tell investors everything that could possibly go wrong. So what's on that list? Well, it starts with their single biggest cost, energy. Wild swings in power prices can just destroy their profit margins. Then you've got regulatory risk. They specifically mention in the report that they had to pull out of New York because of unfavorable laws. That really highlights how much they depend on friendly states like Georgia. They also face tariffs on importing the mining machines they need. And they acknowledge that they rely heavily on their key management team. They even point out that a former CEO leaving could be a negative. And finally, there are the physical risks. Things like extreme weather that could literally take their data centers offline. And the company wants to make absolutely sure that investors are listening. I wanted to pull this direct quote from the report because it's so important. This isn't just your standard legal boilerplate. It is a direct flashing warning sign from management saying, hey, the future is uncertain and things could turn out materially different from our plans. It's a critical piece of context for literally everything else in this document. Now, the financial risks are just as serious. First up, shareholder dilution. They say it plainly. They've funded their growth by issuing new stock. And when you do that, it can reduce the value of every existing share. Your slice of the pie gets smaller. Second is something called counterparty risk. Basically, they rely on other big financial firms for some complex contracts. And if one of those firms goes under, CleanSpark could be left holding the bag. Third, the debt they take on comes with very strict rules or covenants that can actually limit their business decisions. And finally, the big one, the price of Bitcoin itself. If the price of Bitcoin crashes, the value of the collateral they've used for their loans drops with it, which could even trigger a default. Okay, so how do all of these strategies and all of these risks actually show up in the numbers? Let's peel back the layers of the onion and follow the money, decoding the financials right from their report. This number right here is a fantastic place to start. $650 million. In December of 2024, CleanSpark issued this much in convertible senior notes that come due in the year 2030. This isn't just a small loan. It's a massive piece of their entire capital structure and a key way they're funding their really aggressive expansion plans. So what in the world are convertible notes? Well, you can think of them as a hybrid. They start out looking like a normal loan that the company has to pay back, but they come with a really interesting twist. The person who loaned the money has the option to convert that debt into company stock later on. Now, this can be good for the company because it often means they get lower interest rates, but it carries that big risk of shareholder dilution we just talked about if all those investors decide to convert their debt into stock. And here is a fascinating, kind of nerdy detail that the report points out about accounting rules. Normally, debt that's due way out in 2030 is considered a long-term liability. But the report says if certain conditions are met, they might have to reclassify that entire $650 million as a current liability, which basically means it's technically due within 1 year. Now, this could happen on paper, even if the debt isn't actually being called in, and it would have a huge negative impact on their balance sheet's appearance. This slide here breaks down the mechanics of how they actually make money, and it's pulled right from the 10K's accounting section. It's really a 5-step process. First, they have a contract with the mining pool. Second, their job, their performance obligation, is to provide Hashrate to that pool. Third, their payment is the Bitcoin they earn for doing that. Fourth, all of that payment is allocated to the Hashrate they provided. And finally, they get to recognize or book that revenue as it's earned, in a constant 24/7 cycle of providing computing power and getting paid for it. Okay, now we turn from the money itself to the systems that are designed to protect it. And in an industry that is built entirely on digital assets, things like cybersecurity and corporate governance, they aren't just details on a checklist. They are absolutely fundamental to the business. The report shows that at CleanSpark, the board of directors passes the primary responsibility for cybersecurity down to a very specific group, the IT Steering and Risk Committee, or ITSRC. It's chaired by the Chief Technology Officer and includes other top executives. And that structure is really designed to treat cybersecurity as a core business risk, not just some problem for the IT department to handle. And their strategy, as they lay it out here, is multi-layered. They align themselves with a really respected industry standard, the NIST framework. They bring in specialized outside security vendors for advanced monitoring. They have a written plan for what to do when something bad happens, and they actually test it. And there's oversight from the very top, with that committee reporting directly to the board's audit committee twice a year. Now, this slide right here reveals a critical point about governance. The report is very transparent that in the previous year, auditors had found 4 material weaknesses in their financial controls. That is a very, very serious finding. These flaws had to do with everything from IT access to how they tracked their equipment. However, the 10K then goes on to detail exactly how management spent the year putting in fixes, and as of September 2025, they state that all 4 of those weaknesses have been fully remediated. That is a really significant sign that they're tightening up the ship internally. So, we've covered the business, the risks, the money, and the controls. Let's step back for a second and put all the pieces together. What's the big picture that emerges from reading CleanSpark's own report? Well, it's really a story of a fundamental tension, a tension between ambition and reality. On one hand, you have the ambition. This is a company that is in absolute hypergrowth mode. They are rapidly expanding their Bitcoin mining operations, and they're making this bold strategic pivot into the AI infrastructure space. They're building a massive physical footprint. But then, on the other hand, you have the reality, laid bare in this very report. Their core business is completely tied to the volatile prices of both energy and Bitcoin. Their incredible growth is being funded by strategies that carry huge financial risks, including debt and the dilution of their shareholders. And their entire operation is subject to this evolving and uncertain regulatory world that could literally change on a dime. And so, we end with the central question that this entire 10K seems to pose. On one side, you have this incredibly powerful but highly volatile and risky Bitcoin mining operation. On the other side, you have this new strategic pivot into the high-growth world of AI. Can this new venture into AI provide the stability and balance they need to manage the inherent risks of their core business? As the report makes perfectly clear, the answer to that very question is what will define the next chapter of CleanSpark's story.